Hi, class. Let's take a look at Chapter 8 on the efficient markets hypothesis. I think the way to think about the efficient market hypothesis is that, in a nutshell, it says you can't really beat the market because it makes lots of assumptions, kind of like what we went to when we described CAPM. Remember, part of CAPM essentially includes this efficient market hypothesis, and so it kind of lays out the groundwork for it assumes all information is available to all investors. It assumes that prices, when new information comes out, react quickly and rationally. They process the information correctly, and that competition between different investors, all trying to profit and move faster and faster on new information, is what drives this efficient markets. And some of the implications of efficient markets are, what the prices that we see in the market are basically the intrinsic value of how much things are worth. And it also implies that when we look at stock prices over time, they seem to be random. And there's a relatively famous investment book called A Random Walk on Wall Street by Burton Malkiel. And that's where this random walk comes from. And the argument is that stock prices change when new information gets revealed. And we can't always predict when new information gets revealed. Therefore, new information is coming randomly, and therefore stock prices, which react to the new information, are also going to appear random. And so randomness is just another word for unpredictability. And because of this, trying to consistently, year over year, get basically beat the market, or we say superior risk-adjusted returns, is going to be not achievable. And so passive investing, where you're basically indexing and having a fully diversified portfolio of just about everything, is preferred over active investing. And then finally, the good news about this is you would think, oh, we don't need like finance people and investors, and that's not the case. Because if you were to go to an investment advisor, they all pretty much give you advice based on efficient markets. They put you in fully diversified portfolios. And there's a whole world out there of financial decisions besides, what stocks you should buy. So there's still a need for a financial advisor. So how does CAPM and efficient markets kind of come together? I guess it goes through like a hypothetical situation. Let's just suppose that somebody found a stock that was undervalued. They did all this analysis and they're like, wow, this stock should be priced a lot more than what it is. And so what they would do is they would start buying up the stock. And when they start buying up the stock, demand goes up, price is going to go up. And the price is going to go up until the point where the stock is fairly valued or valued at its intrinsic value. So the question now is, okay, well, maybe there are some stocks that are undervalued. Let's assume that, but they're going to go up to their true value pretty soon. This is kind of the theory. And then what should happen then is that you should eventually get an equilibrium, meaning some stocks are priced too high, some stocks are priced too low, and then they all kind of come to the right value because we have all this competition between traders who are constantly looking to beat the market. You may wonder, well, why do we have all these people who are stock picking? And you do have to realize that sometimes investments are sold. They're not necessarily bought. And that may sound like an odd phrase, but it's kind of like, the people who are the best at selling a product may be more successful, even though they don't have the best product, if that makes sense. So the net result is, if you're a rational investor, you want to minimize effort, you should basically buy the market portfolio, the index portfolio that we covered in CAPM. So obviously this is kind of like, if you know the saying of a straw man, you put up a straw man only as like the ideal situation, and then you start, taking it apart, and you start picking holes in the idea. And so in some ways, efficient markets is the straw man. And now we're going to look at how do we test and to see if this really works. And part of the this analysis, this starts getting to a little theory type stuff with the terminology. It's not the most easy to understand, but when we break up this efficient market hypothesis, we break it up into kind of three areas. And these areas are basically ways to test if the markets are truly efficient. And these are the three areas. The first one just looks at the data in the market. And this is mostly stock price, right? And trading volume. So the buying action that's going on in the market. So when we do this weak form of testing for efficient markets, we basically say, if we knew all the pricing data and the trading volume data of history, can we use that to predict where stocks are going to go in the future? So we do studies of that. And if the studies show that we can come up with predictive models, i.e. it's not random, it's evidence against efficient markets. Okay, so kind of the rest of this chapter is all kind of looking at evidence against efficient markets. Then we have these tests called semi-strong form efficient markets, and there we're including public information. Think of this as like the financial statements. All the information you get on the balance sheet, the income statement, all that kind of using all that information, can you predict how stocks are going to do in the future? And then the last one we call the strong form, because it includes all the available information, and it includes private information, stuff that's only known in the boardroom, so to speak. So these tests that we do to see if markets are truly efficient, and when I say test to see if markets are efficient, the other side of that coin is we're looking for strategies to beat the market. So that's what these all are basically. So we're kind of asking the question, do repeatable investment strategies exist that can produce abnormal profits? And if we do find these, that's evidence against efficient markets. And the bottom line is there's evidence on both sides, yes and no. And the evidence of yes, that we can find strategies that beat the markets, so the markets aren't efficient, we call those anomalies or effects, kind of like a UFO, unidentified flying object. And in finance, we call them anomalies, unidentified trading strategies, UTOs or something. I just made that up. So let's take a look at some of this. So under the weak form, remember, this is where we're just looking at price action, including historical stock prices and trading volume. And we call this technical analysis, and we'll look at this some more in chapter 9. But some of the strategies on this, like they look at, like the latest strategies on this, look at kind of real-time data on people buying and selling. And sometimes you can call this high-frequency trading, because they're looking at ultra real-time data very fast from the markets, and they program computers to trade with people and to do lots of limit orders and try to like profit, pennies a trade. But if they do that millions of times, the profits start adding up. And that's one of the themes I think you'll see with some of these strategies, is that they're not very easy to replicate for the average investor. High frequency trading, where you build a data center computer room as close as you can to the computers of the markets, like the New York Stock Exchange, and you're hiring PhDs to develop computer models to trade on high frequency data. That stuff's not cheap, and it's not easily reproducible, and so it's hard to implement. And so that's the other side. Can you find a strategy that beats the market, but how easily can you replicate it and do it on a repeated basis? Another one is called momentum. And we've seen that stocks that have really good price increases over the last 3 to 12 months, that has some predictive power over the following 3 to 12 months. So winners tend to win again. There's momentum in stock prices. And the same thing works with losers. If you have a stock that's been losing, say, over the last 3 to 12 months, it tends to lose again. And the interesting thing here is when this first research started being published and coming out, they were looking at 1 year of momentum. If a stock was a winner for a year, the odds are better than normal that the stock will be a winner for the next year as well. But then through competition and people trying to be the first ones to pick the winners, right? That time period of 12 months started shrinking down. 9 months, 6 months, 3 months, and in some ways we're down to almost 1 month now. In some ways, I would argue, and so people are trying. That's the competition that kind of drives market efficiency, and so it's gotten harder and harder to profit from momentum. So some of these strategies, they're in the textbook, they're in the slides, but the strategy of the half-life of a strategy is becoming smaller and smaller, especially with AI and computers being able to replicate strategies so quickly. Another one was long-term reversals. And this was if you had a stock that did well for 1 year, 2 years, 3 years, after the third year, now statistically there was a better than even chance bet that the stock would do a lot worse. And so it's a reversal, right? It's been a winner for 3 years in a row, and now it reverses and becomes a loser. The semi-strong form basically looks at other data besides pricing and volume, mainly financial data. And you can think of this as like fundamental analysis. This is pretty much the core of financial analysis. And so a couple of things that have been found. One is, on average, small companies tend to do better than big companies. This is using lots of historical data. Now, I will say, if over the last 15 years, it hasn't been so great for small company stocks. It's basically been the big mega cap tech stocks that have really done well over the last 15 years. There have been little periods of just a couple months where small stocks did well. I think right now this is October 25, and I think small stocks are doing pretty well right now. Small stocks did pretty well in I think the end of 2020, right? And so part of the argument here is that when there's something bad in the economy that happens, and banks, lenders kind of restrict their lending to companies, it's the small companies that get hurt the most by these financial restrictions. And so when you come out of that, and things start loosening up, then the small companies do even better. But because of this riskiness of small companies, that the relationship, remember, between returns and risk. If something's riskier, it should have higher returns, right? And so the argument is that small company stocks are riskier, and therefore we see that they have higher returns as well. But again, it's kind of mixed on that. And then we have something called the value effect. And we often use something called the market to book ratio, but similar findings have been found with the price to earnings or PE ratio. And so this is basically a measure of how expensive a stock is, right? And it turns out what it really is talking about is the difference in returns between cheap stocks, or sometimes we call them value stocks, because you're not paying a lot for them for what you get back in terms of earnings, to expensive stocks, which are like growth stocks. You pay a lot for every dollar of earnings from a company like NVIDIA. Maybe right now I think the PE ratio is 50. But there are some small stocks. I was just looking at a car wash public company the other day, and it has a PE ratio of 17. It looks pretty cheap, especially compared to other stocks. So this value effect says that over long periods of time, cheap stocks will tend to give you better returns than expensive growth stocks. It hasn't worked for the last 15 or so years. And then this one is called post-earnings announcements drift. And what we found there is when a company issues an earnings announcement, that's a big surprise, either positive or negative surprise, much higher returns or much higher profits than what analysts expected, right? Because analysts give out their expectations of all these companies' earnings that they follow. And the brokerage houses employ these analysts, and then the analysts their reports are given to the brokerage company's clients to form the basis of making trading decisions. And after the clients are given these reports, then the brokerage companies release them to the whole public, right? Because if you trade on a hunch that something is undervalued, you go ahead and make that trade, but then you want to make sure everybody else knows it's undervalued too, because if nobody else buys it besides you, then the price won't go up. So they kind of release all that information publicly after their clients have been able to trade. And so these companies, when they produce earnings announcements, it's a lot different from what the analysts expected. You would think that the price is going to either jump up or dump down, right? But what we found is that jump takes a lot longer. It's not instantaneous. It can take up to like 3 or 4 weeks, and it's predictable. So what we found is that if you buy the stock after this big earnings surprise, like say it's a positive, you can still earn abnormal returns, more than what the market or CAPM model would predict. Here's a slide that shows what it looks like in graphical form. So each one of these pink lines here are portfolios. So this is and every public company is put in one of 10 portfolios, and based on how big of a surprise. So portfolio 10 had the biggest positive percentage surprise of their earnings over what analysts expected. And so if you follow that one, the big positive surprise, right? You see, well, the stock's already started going up about 60 trading days, right? There are 5 trading days in a week roughly, right? So that's like 10 weeks, even before. And then here, boom, this is time 0. This is when the earnings announcement is made. And now check it out. The stock just kind of drifts upwards. If markets were 100% efficient, instead what we would see here is we should see the line go up real quickly and then go like that, right? That way you couldn't trade on it because it just happens so quick. But because it takes time, you can trade on that information. And that's evidence against efficient markets, basically. The strong form efficient markets is basically looking at insider information. And I don't think anybody believes the markets are efficient with that, right? If you have insider information, yes, you can beat the market all day long. If you know what the earnings are going to be before a company announces, if you know that a company is going to announce a big sales contract before everybody else, but it's illegal too because of that, right? So no, they are not efficient for insider information. So here are some of the factors that affect market efficiency. How efficient are markets? Right? So it's not, we're not saying that they're perfectly 100% efficient, right? So there are some inefficiencies where we can predict where things are going. But what this slide says is that there are factors in a marketplace that affect how efficient markets are. So ideally, we would want markets to be very, very efficient. That would be the goal. Right, so people trust the markets. They don't think they're insiders and that are beating them. They feel like they have a fighting chance, an even chance, just as everybody else. If people trust the markets because they feel like they have a good chance of doing as well as anybody else, then they'll use the markets, and the markets will have the greatest possible benefit to society because companies can get fundraising. If a market, nobody trusts it, then nobody uses it. And in the end, companies can't get funding. So here are some of the things that are important. We want a lot of people participating in the markets. It should be free and open to everybody, right? There should be maximum information availability. Okay, makes sense, right? Companies have to release financial statements quarterly, and they have to be audited. Right? There should be minimal limits to trading. You should be able to do all kinds of trading that you want. You should be able to buy on margin. You should be able to short stocks, right? Because if a stock is getting too expensive and it's a bubble, having short sellers actually helps bring the price down because they'll start selling the stock and hopefully it'll come back to where it should be. Transaction costs should be kept to a minimum. Again, because you want as much trading, frictionless trading as possible to make sure that prices reach where they should. And to do that, you want minimum transaction costs. And if we look at like the evolution of the stock markets, I would say over the last 30, 40 years, there are a lot more people participating in the market. So that's good. I'd say there's a lot more information that there used to be. That's pretty good. We don't have a huge amount limits to trading, right? You can pretty much do all kinds of trading now. Even if you don't want to short, you can buy ETFs that have like inverse and all this stuff like kind of shorting built into them. And transaction costs have gotten close to zero. So markets should be about as efficient as they've ever been in history. Whether or not they are, in terms of what's happening behind the scenes, that's another discussion. But they should be based on these factors. As an aside, there used to be, I would say, at the end of the 80s, that's when there was like a high point of the Securities Exchange Commission starting to really clamp down on insider trading and stuff. So I would say probably there's less of it, but over the last 10 years or so, we've probably seen a little bit more. And it's not so much that this stuff here has gotten worse. I think it's more, at times the Securities Exchange Commission, which goes after insider trading, it's varied over time how aggressive they've been. And I would say right now it's probably been a little less aggressive, at least in terms of like members of Congress and stuff like that, and the trading we've seen going on there. All right, so are markets efficient? The yes side of that answer, they argue that just because you found a trading strategy that earns a profit, you could have just been lucky, because chances are if you look at thousands of different investment strategies, you're just going to find one that just happened to work in that time period. And one of the arguments to support that is when we analyze the returns of mutual fund managers. So we see that there are some years where mutual fund managers do really well and they beat the market. But the problem is, they may do that for a couple of years, but then they start doing worse in the market. It's very hard to find professional money managers who consistently beat the market year over year. Very hard. The no side of this argument, that markets are not efficient, points to some of these studies that we've just shown you, how we can earn some predictable profits from different trading strategies. But I'll remind you that some of them are very hard to do, right? Just because you saw that like small company stocks have done better than big company stocks over the last 100 years, right? What that means is you have to build a portfolio of small company stocks, and you have to reformulate that portfolio because some companies might get bigger and some companies might go out of business like a couple times a year. And then you have to invest in it for at least 10, 15, 20 years. And you wouldn't be too happy with that portfolio the last 15 years, I'll tell you that. So maybe the better answer is how efficient are the markets? And I think the answer to that is they're efficient enough that the really only surefire way to beat the market is with insider information year over year. All right, so that's chapter 8, and I'll see you in chapter 9. We're going to take a look at some theory to try and help explain why we see some of these market anomalies.